Okay, I'm going to show you how to work the comprehensive problem, and I'm going to show you in a spreadsheet, and I'm going to send the spreadsheet to you so that you can use it to do your work in. So I have opened the comprehensive problem, and we're going to do requirement 1 in this video. And we see that Darren Dillard, a majority stockholder and president, is working with his top managers on future plans for the company. As the company's managerial accountant, you've been asked to analyze the following situations and make recommendations to the management team. So we see that Division A of Dillard has $5,250,000 in assets. The fixed costs for the year are $557,000, and the variable costs are $190 per unit. And the current volume is 500,000 units. Now, competitors offer a similar product at the same quality to retailers for $425 each. Dillard's management team wants to earn a 12% return on investment on the division's assets. What is Division A target full product cost? Okay, so to calculate full product cost, you can look on page 1411 and 1412, I believe. So if you want to pause the video and read about target full product cost, it actually shows you the formula on page 1411. We want to figure out what the revenue is at the market price, and then we know that the market price is $425. So our revenue, we know we sell 500,000 units. So our revenue at market price what I would put right here is our volume, which is 500,000. I would put in this little part right here to show your work, 500,000 units times 425 per unit. Once you get that answer, that will be your revenue, okay? The number of units times the market price. And then what we want to do is we want to say, well, how much profit do we want to make? We're going to take that out, and that's going to tell us how much we have to put in the cost for the product. So the desired product, if you look back, we want a 12% return on assets. So 12% times 557,000. So here you would show that you made that calculation. You would put 12% times 5 million. I'm sorry, I don't know if I said that right a minute ago. 5,250,000 assets. Put that right there, and then put your answer right here. So this is how much we're going to sell, the dollar amount, minus our target profit, and whatever's left over is what we want to spend on costs. We don't want to spend more over that. So, and that would give us our target full product cost. When you put these two in, already have the formula set up, it is equal to the revenue minus the desired profit, and that would give us our target full product cost. So that is all you would have to do for requirement 1A. Now remember, you can read about this on 1411 and 1412. We're kind of just rolling through chapter 25, and then we'll work our way through chapter 26. Now let's look at requirement B. Given the division's current cost, will Division A be able to achieve its target profit? So right now we are set, our cost is $190 per unit. That is our variable cost. And we know that we make 500,000 units. So when you're doing your current variable cost, right here you want to show $190 per unit times 500,000 units. Just type that out. And then when you actually do the calculation, put that number right here. Now, your fixed cost, there's no calculation. You're just going to type that right in. They tell you what fixed cost is. Fixed costs are 557,000. So you will just manually type that in. And that will give you your full product cost. So this your variable plus your fixed will give you your full product cost. Now, if your full product costs or your actual current full product costs are more than your target full product cost, then we are not going to be able to achieve our desired profit. Our full product cost needs to either be equal to our target cost or less than our target cost, okay? So if our current number is larger than our target cost, we don't want it to go over our target cost. If it is over that, then we're not going to be able to achieve that profit level that we're wanting to target, okay? And that is all for 1A and for 1B. So that explanation is what I just explained to you. After you do this, you will be able to explain it. Now, looking at question 1C, assume Division A has identified ways to cut its variable costs. So instead of it being 190 per unit up here, we're going to cut it to 175. Now, let's see if we can achieve our target profit. Okay, so what you need to do is your target full product cost, that's what we got up here. Okay, that's what we want to spend on our full product. Now, our target full product cost, let's see, minus the variable cost, okay, minus the variable cost. So now we're going to do here the 175 times 500,000. And then that will, what is left over is what we have left for fixed costs, okay? So if this number here is less than or equal to our fixed cost, then we're good, okay? So when you calculate that, if actually this is what you have left to spend on fixed cost, okay? So you want your actual fixed cost to be either this number or less than, okay? So when you get this number, you'll be happy. This is telling you what you can spend on fixed cost, okay? If you have some left over, we know that our fixed cost are 557,000. So if this tells us we have more than that to spend, then we are in great shape. But if this number is less than what we need, if it's less than 557,000, then we're going to have a problem. We're not going to be able to get that target profit, okay? If you want to see this worked, I'm looking for it. This should be somewhere in between 1412 and 1413. So you should be able to find that. And if you don't understand it, you can message me. I can't find it directly right now. But I think I explained that fairly well. I will say it again. This is what we calculated. This is our full product cost, and we're calculating what our new variable cost is, and then whatever's left over is what we can spend on fixed costs. So just imagine that this is your budget. Okay, this is the amount you have to spend. If you spend actually less than that, if your current fixed cost, what you're spending now, is less than that, then you are good. You will have some money left over, and we will reach our profit. Okay, now for requirement 1D, let's look at it. Division A is considering an aggressive advertising campaign strategy so that its product will stand out. We're not going to expect volume to be affected, but hopefully gain more control over pricing. So if Division A has to spend $120,000 next year to advertise, its variable cost will continue to be $175 per unit. Now remember, this is going to be a fixed cost because this is what we're planning to spend on advertising. And we already have some fixed costs. Remember, we have 557 fixed costs, and now we have this $1.20 fixed cost to add to it. And then we have our variable cost of $175 per unit, and we know we're going to have 500,000 units. So we want to know what our cost plus price will be. Now, if you look in your book, cost plus price is on page 1413, okay? And what you do is you're going to take your current variable cost per unit. Remember, this is the 175. It's not 190 anymore because we decided to change it. It's your 175 times your number of units, 500,000. Write that right there, and then when you calculate it, you put your number right here, plus your fixed cost. But you need to show that fixed cost is 557 plus the 120,000 in advertising. So once you get your variable cost and your fixed cost, you will add that up, and that will be, it will add up manually for you in Excel. That will be your full product cost plus your desired profit. We calculated that in 1A, the 12% times the 5,250,000. So once you get your fixed and your full product cost plus your desired profit, that is called your cost plus price. You take that price and you divide it by your 500,000 units, okay? 500,000 goes here, and that will give you a price per unit. Now, if the price, remember it was selling for $4.25, the market, so our price doesn't need to be like $1 more. If it's 15, 20 cents more, that would be okay, but $1 more would be a little bit too much. So if it's pretty close, you can say that you need to tell what the new cost plus price will be right here, rounded to the nearest penny, and tell me would it be able to sell it at that price. Remember, if it's more than $1 difference between the $4.25 market price, you're probably not going to be able to sell it, maybe. But if it's 10 or 15, 20 cents more, you know, that would be okay. You would be able to sell it. So that is all for requirement 1. If you have any questions, feel free to ask. I will provide you with this spreadsheet so you can put your numbers in.